Welcome to this training on building a complete customer profile. This is a structured guide designed for anti-money laundering or AML, fraud, sanctions, and financial crime investigators. We will walk through every layer of a customer profile, from Know Your Customer Records or KYC all the way through to behavioral analysis. By the end, you will have a repeatable framework for assembling the evidence base that supports every investigation you work. Why does a complete customer profile matter? Because it is the investigator's foundation. Without it, transaction anomalies have no context, and context is everything in financial crime. Think of it in three parts. First, know the baseline. You must define what normal looks like before you can identify what is suspicious. Second, prove intent. Inconsistencies between a customer's profile and their actual behavior form the core of a defensible suspicious activity report or SAR narrative. Third, connect the dots. Related parties, channels, and history reveal networks that a single alert will never catch on its own. Start every investigation by pulling and verifying the full KYC and Customer Due Diligence or CDD file. There are four key areas to examine: identity documents, government-issued ID, passport, date of birth, and tax identification number. Confirm document authenticity and check expiry dates. Verification results. Look at ID verification scores, liveness checks, document fraud flags, and address verification outcomes from onboarding. CDD risk rating. Note both the initial and most recent risk rating, the date of last review, and whether enhanced due diligence or EDD was triggered and what it found. For business customers, examine beneficial ownership, ultimate beneficial owner declarations, ownership percentages, control structures, and corporate registry filings. Always flag any gaps. Missing documents, expired IDs, or unresolved verification failures are red flags in themselves. Occupation, income, and source of wealth. These three elements define the financial capacity of a customer. They set the ceiling for what transaction volumes, account balances, and fund flows are plausible. Verify the stated occupation against payroll deposits, employer records, or business filings. Compare declared income to actual credits flowing into the account. Significant excess demands an explanation. Source of wealth should be documented, not just declared. For high-risk customers, request supporting evidence such as property sale records, inheritance documentation, or investment statements. For business customers, review the business model, revenue streams, and typical client base. If the money moving through the account cannot be explained by these three factors, you have a lead worth pursuing. Now let's look at products, channels, geography, and related parties. List every product held: current accounts, savings, loans, cards, foreign exchange, and crypto. Note whether the customer uses digital channels or branches, and record any channel restrictions applied. For geography, document residential and mailing address history, IP login locations, transaction jurisdictions, and correspondent bank corridors. Flag any high-risk or sanctioned countries immediately. Related parties are critical: joint account holders, authorized signatories, guarantors, beneficial owners, and frequent counterparties all belong in your profile. Build a relationship map. Money often moves within networks, not in isolation. Finally, record expected activity. Documented transaction volumes, frequencies, and counterparty types from onboarding or the last review become your baseline for anomaly detection. Screening results and internal history add crucial risk intelligence to your profile. Start with sanctions screening. Check OFAC, UN, EU, and HMT lists for the customer, their ultimate beneficial owners, and related parties. Document any hits, false positives cleared, and escalations. Check for politically exposed person or PEP exposure, direct or by association. Note the jurisdiction, the role, and whether EDD has been completed and approved. Search adverse media for fraud convictions, money laundering charges, regulatory actions, insolvencies, or negative press. Always document the source and date. On the internal history side, pull all previous transaction monitoring alerts, their disposition, and the rationale recorded. Patterns across alerts are significant. Review complaints, disputes, fraud claims, and any account restrictions or blocks. including who authorized them and when. Finally, note the relationship history, account opening date, relationship manager notes, service interactions, and any demarketing discussions. Long-standing customers with sudden behavior changes warrant particular scrutiny. Once the profile is assembled, place it side by side with actual transaction data and digital behavior. You are not just looking for anomalies, you are looking for contradictions. Compare the profile baseline, declared income, expected activity, and risk rating against actual activity, transactions, channels, counterparties, and geography. Where they diverge, identify the specific contradiction. Is it volume, geography, counterparty type, product misuse? Then document the relevance. Link each gap to a suspected crime typology. Every contradiction must be recorded with a clear explanation of why it matters to the specific crime type under investigation, not just that it is unusual. Let's get specific about what inconsistencies to look for. There are 4 primary categories. First, volume versus income. Transaction throughput or account balances that far exceed declared income or business revenue. This is a classic layering signal. Second, geography versus profile. Funds flowing through high-risk jurisdictions with no plausible business or personal nexus to those countries. Third, counterparties versus business model. Payments to or from entities unrelated to the declared occupation. For example, a retail employee receiving large wire transfers from offshore shell companies. Fourth, digital behavior versus declared use. Login patterns, device changes, multiple accounts accessed from the same IP address, or velocity inconsistent with the stated purpose. These are key fraud and account takeover indicators. Let's walk through a case study. Maria T is an import and export agent, a sole trader, with declared income of $85,000 per year. Her expected activity at onboarding was domestic supplier payments and modest foreign exchange. Her risk rating was medium, with EDD completed 18 months ago. No adverse media was found at onboarding. She holds 1 business account and 1 personal account. Here are the contradictions found. First, $2.3 million in foreign exchange transfers to 3 high-risk jurisdictions. This far exceeds her declared income and modest FX profile, yet no new EDD was triggered. Second, her counterparties are newly registered shell companies. None match known suppliers. Trade invoices were provided, but goods descriptions are vague and values appear inflated per commodity databases. Third, a rescreen revealed a recent adverse media hit showing a regulatory enforcement action in a foreign jurisdiction, not present at the last review 18 months prior. Each contradiction was documented and linked to a trade-based money laundering typology, over and under invoicing, shell company use, and jurisdiction risk. That connection to typology is what makes the SAR narrative defensible. A complete profile is only as valuable as the written analysis that accompanies it. Your documentation must connect evidence to the crime theory, clearly and defensibly. Follow this 4-step structure. First, state the profile. Summarize all KYC, CDD, expected activity, and screening findings in a single narrative paragraph. Second, describe the activity. Quantify actual transactions, volumes, frequencies, counterparties, channels, and geographies observed during the review period. Third, articulate the gap. For each contradiction, write a specific sentence stating what was expected, what was observed, and why the difference is material to the typology. Fourth, conclude and escalate. State your conclusion, file a SAR, close with monitoring, or refer for an EDD refresh, and document the reasoning that supports it. This framework ensures your analysis is structured, repeatable, and audit-ready every time.